Welcome everybody back again to another episode of the DistressedPro.com professional podcast series. Today I'm really happy to have Jeremy Serrier on the line. He is a friend of mine. We've also been in business together in the past. We don't need to talk about that. But he's a broker owner. He owns a commercial real estate brokerage in the Boston area. He is a CCIM instructor, and he's really one of the foremost authorities in our local commercial real estate market. And I asked him to come on today because we are taking a look at, in this podcast series right now, we're taking a look at 2013 and how to be successful in 2013. And so I want to tap into Jeremy's brain here today on the line and have him walk through with us a presentation that he's put together, which includes some predictions that he's going to walk us through. And from those predictions, what we want you to be able to do is go forth and prosper in 2013. And so, Jeremy, did I miss anything? I know CCIM's recently moving you up the line, and they're pulling you in. What's happening with you professionally? Can you tell us about it?
Well, thanks, Breck. At the CCIM Institute, I've recently been they're pulling me deeper over there. I got on became one of their instructors in 2008, and I'm a senior instructor now for the Institute, one of 85. We're a 14,000 member organization worldwide, and I teach their financial analysis and market analysis courses. I've taught people from the U.S. State Department, Walmart, Walgreens, CVS, Dunkin' Donuts, you name it, GE. I've had them in a class, and at the Institute lately, they've pulled me up. I'm now sitting on the board of directors at the Institute level, as well as serving as the 2013 presidential liaison, which is kind of like being a vice president. They changed the name a few years ago for technology, which means that I'm interacting with all of the latest technology in commercial real estate that the Institute produces and makes available to their members.
Well, that is awesome. And just in case people don't know, I know most of the people who would be listening to this would know what CCIM is, but maybe we ought to just make sure our bases are covered. Can you just tell a little bit about what CCIM is?
Yeah, CCIM, it stands for Certified Commercial Investment Member. It was a designation that was created about 40 years ago, and it was set up to give commercial real estate professionals, so professionals being defined as brokers, investors, developers, lenders, attorneys, CPAs, so on and so forth, the ability to use a common language when they were working with one another in commercial real estate. And the designation was formed around this idea that if everyone has a similar language, that they're going to be able to do business more profitably and efficiently with one another. So over the course of the 40-year period of time, the Institute has been known to develop these core courses. They have 4 core courses they offer: Introduction to Financial Analysis for Commercial Real Estate, Market Analysis for Commercial Real Estate, User Decision Analysis, and then Advanced Investment Decision Making. The 4 courses might take you a year or two to finish, and then you have to submit a portfolio of qualifying experience, which essentially says that as a commercial real estate professional, you've worked for at least 5 years in the industry, and that you've accomplished a certain level of standard of production in the industry. And at that point, you're invited to come sit for their final examination, which is a 6-hour exam, and if you pass, then you're given this prestigious designation, the PIN, the CCIM PIN.
Right. Well, awesome. Thanks for going over that. And anybody who is interested in learning more about CCIM, before we forget about this and move on, where would they go online?
Well, it's easy. It's CCIM.com is the website. You can go there and read up on the Institute and all the latest news going on.
Well, great. So let's dive into, I want to talk about the materials that you've put together here, these 6 CRE investing predictions for 2013 and beyond, so we can really just jump in and get to the meaty part, which is what people want to know, which is where are the opportunities, where are they going to make money in
Mm-hmm.
2013. So
Mm-hmm.
you want to just kick it right off with prediction number 1, or do you have some other things you want to get into?
Yeah, no, that's fine. We can jump in. When I was thinking about this and putting together my thoughts for 2013, I had just come from a roundtable discussion. It was actually a bunch of CCIMs that got together a few weeks ago, and we were talking about the market. And one of the things that was a dominant discussion topic was interest rates and the state of interest rates today being where they are. And one of the things that I threw out into the conversation, and was kind of called a contrarian for doing this, but I said, we're entering an environment where we have some cap rate compression due to capital coming back into the market, chasing yield in commercial real estate. But we also have this low interest rate environment, and the risk we run is essentially seeing volume and dollar size of transactions returning to pre-recession levels, 2007 levels, and there was concern in the room over that trend, but also the interest rate question. Well, what happens when the rates can't go down anymore and they start coming back up? What will that do to valuations? The bigger question that I had wasn't so much in relationship to rates, because I think the rates are going to stay low for quite a while as the government works to inflate our economy up over and out of the trough that we've been in. I think the bigger question is going to be tax changes, and we've seen a lot of information lately about tax changes in the United States, and what's going to be agreed to or not agreed to is unsure. But there's one thing we know, and that is that taxes have to go up. Taxes have to go up because the amount of government spending has gone up. The government is taking in less money than they're spending, and they have to pay for these programs. So the real issue that I think we're going to have to deal with in 2013 is not so much interest rate exposure as it is tax exposure. Now, I'll carve out the pension funds and the REITs, and they're in a different world tax-wise. But for most of the folks like us, Brack, that are
private owners, you're talking about.
Yeah, I mean, we've got, we put our own dollars in deals. That's taxes are a real concern. So I think what's going to happen in 2013 is we're all going to wake up and realize that taxes have gone up. We have to start to underwrite those new tax structures into our valuations. And when you have a higher marginal tax rates, that means your cash flows are taxed at a higher rate, and you have a higher capital gains rate, which means when you sell, you're paying more money to your partner, the IRS. You're going to have to be more sensitive to how you underwrite your acquisition going in. And that very move of underwriting to tax sensitivity and tax exposure over your holding period is going to lead to a widening in the buy-sell gap in the market. And I think buyers are going to start to have to price in the additional value they're going to need because of the additional taxes they're going to pay, and you're going to see some downward pressure on values. A little, it won't be significant, but there's going to be some downward pressure. So the key here, the key takeaway on this is that when you're underwriting for acquisitions you're going into over the next 5 years, keep in mind that when you're planning your exit, you're going to be exiting in a different tax environment, and the buyer for the property you're selling is going to be going through the same thing. So it's out there, it's in the shadows, but it's going to come up and it's going to creep into our market.
I think there's a very real chance of exactly what you're talking about happening there. And so, in case people are listening to this and not watching, I just want to state prediction number one then is tax changes give investors pause and causing more conservative underwriting. And so, what is there an answer to that? Is there something that you or I can do to hedge?
Well, sure. You can always buy in your IRA. One solution. I don't always love real estate in IRA, and that's because unless you're paying all cash for a deal, you are subject to paying taxes. Your IRA actually pays taxes on real estate it owns when it's leveraging the real estate. So, that being said, the IRA is not always a great place to go. But if you're doing, high capital gains exposure, investing in real estate, i.e., developing a piece of land, you may be in a short-term gain scenario. It would be smart to have it in your IRA to shelter those gains from taxation. Another way to look at this is keep an eye on the mortgage interest deduction and your depreciation allowances. You can always use cost segregation to accelerate your depreciation on your hold, so that can reduce your tax liability on the cash flows while you're holding the property. That's a bonus, but again, you're going to have to keep in mind when you sell it, you're going to have to pay back a portion of that to the IRS. They have a cost recovery tax. So right now it's 25%, and if you do cost segregation, sometimes that can be treated at a marginal tax rate. So you actually pay it back at, I think they're talking right now about maybe going to 37% on marginal tax rate. So that could be a tax bill you have on the cost seg. But so we got IRA, we've got cost segregation, using leverage, that mortgage interest deduction. As long as that doesn't go away, even though it's being discussed on the residential side, I don't think they'll touch it in commercial real estate. All of us tend to use leverage in this business, so knowing that you've got that deduction is a benefit as well. And just off the top of my head, I'm trying to think of other besides that, just underwriting conservatively and keeping in mind that your spread between your cash flow before tax and your cash flow after tax is going to be a little wider than it used to be. And you can adjust your acquisition. I mean, I was just in the process of going to buy a 30,000 square foot building in Connecticut. I was putting a group investment together to buy that, and we had an issue there where it was a 12 cap deal, and we had 10 years of term left with the tenant. And one of the problems we were facing was that Connecticut has a tax rate of 7.5%. And then we had the marginal tax rate of 35%. Well, when you're on a 12 cap deal and you're running a high cash on cash return, and we were up around 19 to 21%, you're paying about 42.5% of your income to the government to own that asset.
Wow.
So we were going from a leveraged before tax return that was in the mid-teens down to an after-tax leverage return in the single digits. And as a result of that, we had to go back and reformulate our offer because of the tax exposure on the investment. And ultimately, we ended up reducing our offer by $600,000 to the seller because of the taxes.
Wow.
So when you're going to buy a piece of property, keeping that tax exposure in mind and what you pay, it's real money. It's real money, and it's return you're not receiving. It's return your partner, the IRS, is receiving. So that's why I brought this in as the number one prediction. I think the tax question is a very, very, very important factor going into 2013 to keep in mind.
Cool. Well, let's blast on to prediction number two. Apartment investing remains hot. A lot of people are talking about multifamily right now. We know that that's on fire. You think this is going to persist through 2013?
I do, and it is going to persist, and one of the reasons is that multifamily is one of the best understood investment vehicles in the commercial real estate world. You got the largest pool of buyers and sellers in that space, so that's a positive. Secondly, apartments formulate one of the most important aspects that we all rely on, and that's shelter. I mean, everyone needs a place to live, so that's one of the other reasons. But additionally, what we've seen is demographically, we've seen an undoubling in the market, meaning that the college kids that graduated, moved back home with mom and dad, they're now getting jobs, and they're going out and getting their apartment. You've got folks that got really hurt in the housing market, foreclosures. They're moving into the apartments. Rents are starting to increase, and we're just seeing demand demographically. We're seeing demand for rental housing, and I think there's going to be a layer here in 2013 that what'll happen with the Obama administration and the job market is I think we're going to have a little bit of a softening in the job market as the tax rates come into play and the Obamacare costs come into play. I think the job market's going to slow back down a little bit, and people they're not going to be able to buy homes. You're going to have kind of a tale of two markets. It's going to be those folks that used to be above that 63 or 64% home ownership rate in the United States that were owning that can't anymore. They're having a hard time getting back into the market. They're going to be living in apartments. They're going to be there for a while, and they're going to be tempted to get back in. And we're going to talk about that in one of my later predictions, because there is this other side of the market that's bubbling up. But I think the apartments are going to continue to be hot, and I see them. I see this trend continuing for the next couple of years, at least, in the market.
So the opportunities there, increased rents, lower vacancy, the dangers perhaps are cap rate compression. Are you getting in at the top of another bubble?
Yeah, that's an issue. And you think about this, in Boston, we're seeing multifamily trading in the 5 caps. Now,
it's 2007 all over again.
Yeah, I mean,
or 6.
But the difference is back in the mid-2000s, a lot of that cap rate compression was driven by the condo conversion model, and it was, look, we're not valuing this asset based on the income it's generating, because I'm going to be terminating the income on it by converting the use to condominiums, and then selling the condos off and harvesting all that additional equity valuation by unbundling the asset.
Right.
This market's different. The market we're in now is an income-driven market. It's not necessarily a speculative appreciation market, which is good, and that's going to help to keep cap rates somewhat under control. But as long as we have debt in the marketplace in the 3% range, which you can pick up from HUD on a 40-year AM, that's cap rates are going to come down. You're going to see a 200 basis point spread from your debt cost to cap rate cost. So that's something to watch. And the play there is to really, really be mindful of occupancy and rent growth, because cap rates will start to come up a little bit. And when they do, you want to make sure your rent is pacing at a growth rate that's going to allow you to maintain your valuation as your cap rates start to come up a little. So that's something to keep in mind. And the other thing on the apartment investing is that I like apartments that house people that are at or below the median home ownership cost. So, for example, if you're in a market where you can buy a piece of property, a condo or a single family, and it costs you, say, $1,500 a month, principal and interest, taxes and insurance to live there, but you're living in a $1,000 a month apartment because that's all you can afford, you're not going to be able to make that $500 gap. You can't jump into the homeownership market.
Mm-hmm.
You're going to be a tenant, and you're going to stay a tenant. So I like multifamily that has long tenure tenancy. I like the multifamily that has pricing that isn't competing with home ownership cost, that allows you to hedge and protect your tenant base from shifting.
Cool. Number 3, retail recovers and resizes.
Yeah, so what's interesting in retail is that it was in the 2000s, it was really overbuilt. There was a lot of spec retail going up, and traveling around the country, I was in Houston, Texas a few weeks ago, and I was just driving around looking at all the dark spaces there. You find you've got centers that are 5 years old and they're 35%, 40% occupied. What's happened is retail has started to come back. Retailers had pulled back dramatically in 08 and 09 in the market, and they weren't moving forward with expansion plans. They're now starting to come back into the market, but the retailers that we're seeing, they're different in the sense that it's the same names, but they have a little different formulation on how their business is going to work. So as they come back in, I'm seeing a resizing trend in retail. And the resizing trend it's the story of a Best Buy that's coming out of a 40,000 square foot store trying to downsize. If you go to the mall, you're seeing Best Buy mobile stores. Staples, they're moving. They used to be a 12 to 14,000 square foot store. They went up over 24,000 square feet. Now they're starting to come back to 18,000. Circuit City went out of business. What happened to a lot of those stores? You didn't necessarily see backfilling of the space with another big box retailer. Rather, you might see two that go in and cut the space down. So what I'm seeing in retail is an opportunity to adjust and resize space to accommodate new retail demand. And that retail demand is being driven partially by online retailing, where retailers typically used to inventory pretty heavily in their stores. They're now looking for lower inventory solutions in warehouse and distribution centers and using just-in-time delivery techniques to get the product into the stores when they need it. So as a result of that, they're looking to reduce their cost for space, that high-value cost space that is customer-facing. They're looking to move that into smaller bites. So the opportunity in retail is you're going to see, and it's already happening. I use Best Buy and Staples because they're great examples. You're going to see them. You see a lot of owners taking those properties to market, wanting to sell them and get out of them because they know that there's change coming through, and they don't want to be exposed to that in the event that Staples or Best Buy opts to either go dark or they just aren't going to renew on the options. So the opportunity there is to find the best located stores. And I would go in and say, look, I'll take you down, let's subdivide and get you a smaller store, but in exchange for doing that, I want you to come back and agree to a new 10, 15, 20-year term for the space. So I like 2013, I like working with the retailers to resize them, get them back to where they want to be, but ask them to make a renewed commitment in exchange for making that change.
Sure, and I guess on the other side of that, part of where that opportunity could be is depending on really the state of your tenants or how aggressive they are or how dire their situation is, then we could certainly see more retail in the hands of the lien holders, as we're coming through this year, as it's still shaking out, especially if there's compression in terms of size.
Yeah, you're going to see that, and the big question is, I've done work on some of these properties nationally. I've gone out to California on Circuit City deals, and we've had issues where you've got a vacant big box, and it's great. The first piece of that equation being it's distressed, it's empty, Lien holders got it; they want to dump it.
Mm-hmm.
But unless you've got a adapt and reuse plan in place that you think you can pull off, all you're doing is just stepping into the shoes of the last guy.
Right.
So
you really got to come in with a plan on these.
Exactly. So you got to have a plan. And I, when I put this prediction out there, it's look, the market's changed and demand has changed, and if you can reposition the space to meet up with where the demand is, you're going to make a lot of money. So I think you find a way to take that space and remarket it in a functional way to where the demand is, and where the demand is going is it's going to a smaller footprint. That's
right.
just where we're headed.
Cool. So number 4, the land market heats up for home building. Now this is an interesting one. Tell me about this.
Yeah, so in prediction 2, I tell you that the apartment market stays hot, and then in prediction 4, I say the land market heats up for home building. And this is what I was referring to, this tale of two markets. If you've been following what's going on Wall Street in late 2012, what you're hearing is a lot of investors are moving into residential real estate stock.
Mm-hmm.
So I'll give you an example. Warren Buffett just made a big investment in the Prudential real estate brand. He just put a bunch of money there, expecting the brand to generate pretty hefty profits over the next 3 to 5 years. Realogy, they're the owners of Century 21, Coldwell Banker, ERA, so on and so forth. They are in the process. They've gone through a big restructuring and are now one of Wall Street's favorites for yield in the residential real estate world. Toll Brothers, Pulte, Lennar, these are all companies that are attracting investment. And the reason for this is that the market sees home building as a recovering market, and a lot of the smart money is getting into dirt now. The smartest money got into dirt in 2010 and 11 and bought it cheap. They're the ones who've got the healthiest balance sheets and are poised for pretty hefty profits here over the next couple of years. But the home building market is just now, it's really starting to come back. And you've got pent-up demand. You do have people that have been living in these apartments. They like new product. They want to move into a new home. The building is picking up, and you're just going to start to see this happen in 2013, where home builders are back, and it's not going to be what it was back in the mid 2000s, where there was a lot of spec home building. It's going to be more measured, but you're going to see some new home starts picking up in 2013, and I think the opportunity here is to look at raw land or entitled land. I can tell you in Massachusetts, we had a lot of 40B projects, which are like affordable housing, where we have the state statute that says each town needs to have about 10% of its housing stock is affordable. That those projects, a lot of them were put on the shelf in 08 and 09 and just left to collect dust.
They're now being foreclosure on a number of them.
Yeah, and I know, Breck, you were very active on those.
I was.
Liquidating failed subdivisions and 40B projects.
Yeah.
Those are now coming back out into the market. They're being dusted off and repositioned.
So my question about that, do you think there's the debt available for that?
So that's the question. That is a good question. Is there debt? Yes, there is debt available. The debt for that market is re-emerging now. And if you look around in your markets, you're going to see the debts come in first into the apartment market, because you're going to see new multifamily projects going up. Mm-hmm. That's the first phase of the debt coming back into the residential sector. The second phase is going to be the townhome and single-family sector. Following that, I expect to see mortgage underwriting loosening up a little bit, because there's going to be pressure on the banks to then move those products through to the end user, the homeowner.
Right.
So I see that coming. It's not going to be a steep run up like, it's just not going to go really fast and hot, but it's going to be from where we've been, which has basically been flatlined. We're getting some blips, and you're going to start to see this trend up a little bit. So I see some opportunity in that sector, and I think 2013 is going to be a good time. There's going to be a window there of about 18 to 24 months. You're going to see this market start to pick up.
Well, all right. So prediction number 5, office demand realigns with new work trends. Tell us about that.
Yeah, so go ahead.
No, I'm sorry. I said tell us about that.
Okay. So in some ways, we talk about resizing in retail. Office has gone through a similar experience, and what I mean by that is that we've gone from a demand ratio in office of about 200 square feet per employee. So if you imagine being an employee at Dunder Mifflin, you'd have a 20 by 10 square foot space that essentially you own and occupy. Now companies are moving down to the 125 square feet per employee, so almost cutting in half their demand for space. And so what does that mean for office investors? Well, big problems. If you're in office and you've been relying on your tenant to expand, the trend that's occurring, and a big story in Boston right now is State Street Bank. They're in a 1 million square foot office building in downtown Boston. They are now moving to the Seaport District in Boston. They're moving into 600,000 square feet. So they're getting rid of 400,000 square feet of space.
Wow.
Sun Life, a big insurance company in Massachusetts, they're completing a 500,000 square foot campus. They are using a calculation of 125 square feet per employee for their space planning. A friend of mine who works at PricewaterhouseCoopers in their real estate department was bragging to me about how in 2011 he was responsible for reducing their national footprint by 900,000 square feet. So the question is, what does this mean for us? What does it mean for the people that are occupying these properties? Well, the first thing it means is that companies are opening up space. They want open collaborative space. They're also home officing employees. So you've got to factor in if you own office or if you're going to be buying office, and there's probably going to be some office that you're going to see coming through the banks. You want to really take a close look at your floor plate sizes. You want to see how much space you're going to have, and you want to see what your average tenant size is in the market. And I'm talking about a 2012, 2013 tenant size, not one from a couple of years ago. So there's a company that I watch here in Boston called Synergy Investments, and they've done an awesome job at niching themselves into the Class B office market. What they've done is they've just gone out and started acquiring buildings that are not core, publicly traded REIT-style towers. They're buying these mid-rise office buildings, these B-class buildings. Their average tenant is 7,000 square feet. And what they're doing really well there is they're positioning the B office with some upgrades for the tenants and giving them the floor plans they want, but they're operating right in the center of the marketplace where you've got the highest concentrations of small to mid-sized companies. They're catching the companies that are reducing their per square foot employee count, so they're going into smaller space. They're catching them, and they're also catching the companies that are growth companies, but it's sitting right in the middle of the market. So I really like their strategy, what they're doing. The large floor plate properties scare me. I think we're trending the opposite direction from where those buildings are sitting, and it's the owners and the landlords of those properties that are really innovative in figuring out how to cut up and to reduce their overall square footage size in 2013 that are going to survive and do well.
Yeah, you know, I was in Connecticut recently looking at a something for a bank, and it was a campus. It's a whole I forget how many square feet we had, but it was a significant sized campus. It was a former campus of the Hartford, and dark, the whole thing dark, and a lot of it, you know, kind of been left abused for a while, right off the highway. I mean, it's very convenient in a you know, a wealthy suburb, and you know, that had a lot of that going for it. But it was one of these huge floor plate type. You know, what else do you do with the things? And I think, you know, lenders or whoever else is holding onto those empty is going to have a real hard time with figuring
Mm.
out how you're going to make that work.
It's tough. You know, one of the things that we do at my brokerage company, we have an advisory services division, and we actually try to figure that out for people. They'll hire us to come out and look at assets like that and put together a highest and best use analysis, so they can reposition that space because it's there. You got to do something with it.
Right.
And if the demand isn't there for it, you got to find where the demand is in the market and then move that space over into that area of the market where you're going to pick up some positive activity and absorption.
Right. Well, you could always tear it down and make a truck stop. Those things are selling like hotcakes. So
There you go. Yeah.
prediction
Yeah.
number six.
Forget your basis, right? Just go for it. Tear it down.
Yeah. Well, that's the thing about basis is, you know, once the lender's got it, you know, what is that anyway? It's where they've written it down to, and it's, you know, what they can stomach. It's not, you know, it's not so, you know, it just changes a little bit once you've got once the lender is the owner, you know, I guess. And so
Mm-hmm.
I think
Mm-hmm.
it's highly likely we'll see more of that in office this year.
Mm-hmm.
Industrial holds steady with modest gains.
Yeah, so my sixth and last prediction is the industrial market, not seeing a lot of spec building there. What I like there is that, look, industrial typically tracks with GDP growth, and in 2013, the Conference Board is estimating GDP to grow by 1.8%. Just to put that in perspective, we were over 2% in 2012, so not really hot stuff.
Mm-hmm.
But we are expecting 2013 to 2018 2% annual growth. Now, if industrial as an asset, as a sector, tends to track with GDP, and GDP is only growing at 2%, which isn't that fast, why would you want to go there? Well, one of the reasons that I say you go into industrial, and if you focus on it on this specific sector that I'm going to give you right now, there's going to be some money to be made. And the money to be made in industrial is in the logistics and warehouse distribution properties. These are the properties that you see FedEx going into. FedEx has had some of the most profitable years lately, and the reason for that is that companies like, you've heard of them, Amazon.com, they're selling
Sure.
a lot of products online. Well, how are they getting a product from the point of purchase to the consumer's doorstep? They rely on logistics companies, UPS, FedEx, so on and so forth, to move the products. And those companies all need warehouses, and they need distribution centers that are concentrated strategically across the United States, but also within submarkets to get to the customer as quickly as possible. They need those locations to deliver the service, to deliver the product, and to do it profitably and efficiently. So I really like that sector in industrial, the logistics, warehouse, distribution. I think it's being driven faster than what you're seeing with GDP, and it's being driven by a change in consumption behaviors in the U.S.
Great. So this sounds to me, as we read through this, it sounds like if you're this isn't something you're dabbling in. You've got to know your users. You've really got to know your market.
Yes.
Yeah.
Yes.
Yeah.
You do, and that's one of the things. If you want to be successful, what I teach people is you've got to pick really there are four different areas to focus on. And if you pick one or two of those and you stick with them and you go deep, you're going to know this stuff, and it's going to make a lot of sense to you. You're going to be able to look out 12, 24, 36 months down the road and have a pretty good sense of where the opportunity is and where you should be coming into the market and where you should be exiting the market.
Well, I want to put in a plug for you about your CRE Invested because I have been through some of the stuff, and I'm just, of course I know you, and so that doesn't hurt. But I've just been really impressed with all the materials that I've seen and with the amount of information that you have. And so, if you would, just for a minute, what I might like to do is ask you if I get some positive feedback from this call and from this video, then maybe I'd love to have you come back and maybe we focus in on one particular thing that somebody can do in 2013 in commercial real estate to be making money. But maybe if you could just give us a quick sort of encapsulate what CRE Invested is and what you're doing with that portion of your business.
Mm-hmm. Yeah, so as you know, I've been teaching for the CCIM Institute, and it's been a great experience for me in the sense that there's a lot of theory behind commercial real estate. There's a lot you can learn in the classroom, but there was a problem that I found that I faced, as well as investors I work with and partner with on deals. What the problem was okay, look, you're in the classroom, you understand sort of how the stuff works. And then there's the market, and they're two different worlds. The classroom's great because it's this kind of controlled environment, but when you get out in the real world, it's messy, it's sloppy, there seems to be no sense of order to it, and there's this gap that exists between the two. And I call that the theory and application gap. The CCIM Institute is great. They're all the courses are taught by professionals that are out in the world practicing. They bring that into the classroom. But what I wanted to do is say, okay, that if we take what's most important theoretically, but then we apply it into the marketplace, I want to create a bridge between the classroom and the market and give people a blueprint or a roadmap, a system really, to bring control to all that mess. And what the control allows you to do is to create a unique and differentiated position for yourself in the market of your choice, to then go out and source and find the best deals in the market to buy on the best terms. Doing that on a very strong foundation of core fundamentals in commercial real estate investing. So what I did was I authored this course and put this together, and I'm now offering it to investors, and the investors that I really want taking it are the guys like us, Breck, that it's our own sweat, blood, and tears and money that have gotten us here and doing this, and those are the people that I'm like you. I want more for myself and for my family, and so I've put all the stuff I've talked about, everything I've learned over the past 14 years in this business, and everything I had to relearn after 2008 into this course, and I'm giving it to people.
Well, that's awesome. And so I think that if that sounds like something that you'd want to hear more about, or if you wanted to dive deeper into a particular topic with Jeremy at the Distress Pro or on DistressPro.com or within our professional podcast series, let me hear about it. Send me an email, drop a note in the comment section, and we will get him back to do a deep dive, maybe on finding the deal or on financing or on one of the key components that's going to get you to making money and being successful in 2013. So Jeremy, I really appreciate you coming on here. If somebody wants to shoot you an email or get in touch with you, what's the best way to do that?
You're welcome to email me directly. I answer all my own emails. It's Jeremy, Jeremy, at creinvested.com. That's creinvested.com. Or you can just go ahead and give me a call directly. I'll give you the phone number here to our office. The phone number is 888-224-6650. 888-224-6650.
Jeremy, thank you so much for coming on. I really appreciate it, and I look forward to grilling you in 12 months to see which of your predictions were accurate. So,
thank you, Breck.
All right, thanks a lot, man.